revenue recognition, this is the one that's still coming. We still have the same 5 steps, right? And this is where we all have to step back and say, the first question we have to ask ourselves is, what are all of our revenue streams, right? The second step we have to say is, how many, within those revenue streams, how many different contracts do we have within that? This standard completely takes out any contributions. So contributions are explicitly excluded from this standard. Contribution accounting has not changed until I get to the next standard. But it has not changed. So any of those that you're dealing with somebody where it is an exchange, it is a reciprocal transaction, they are giving you money and you are giving them something back in return that has commensurate value, which I would, for a membership organization, I would expect most of you would say your dues are likely, majority, let's go with, or a commensurate value, right? They are getting value from that. A portion of your dues may be contribution, and at this point, we may need to bifurcate that out and separate it out a little bit. But the one thing I want you to understand on this standard is there's a practical expedient that if all of your revenue transactions, or whatever revenue transactions you have, if they all begin and end within your fiscal period, you're not going to have a recognition difference. You will 100% have a disclosure difference. There are new disclosures. Everybody's going to have new disclosures. But if all of your revenue is recognized within your fiscal year, you will not have a recognition difference. And there's a practical expedient that you can go past that. But if they don't, if you have the anniversary date renewal of our memberships, then you will have some deferred, and you have to look, again, bifurcate out. So it's looking at your contracts, your membership contracts, and saying, what are my different performance obligations within there? Getting rid of the immaterial ones. You know, your affinity programs, the fact that because they're a member of you, they can get a discount at Hertz. Okay, you can get a discount at Hertz just by calling Hertz. It's a great benefit, but it's probably not something that's going to impact your revenue recognition, right? So it's really stepping back and saying, which ones of my performance obligations for my members is there actually a value that they're getting back, and allocating it across that, and then determining what part of my fee would it be allocated to those different pieces, and then allocating that membership due across that, all those different pieces, to say, if it's over time, if all of my membership benefits, if it's a stand-ready benefit, like advocacy would be likely a stand-ready benefit. I stand ready to be an advocate for my members, and so any of the amount of the dues that I determine as advocacy is stand-ready, that's likely over time, evenly over their term. But if a portion of their dues allows them to come to a conference, and that conference is at a specific point in time, when is that point in time in relation to when they paid their dues and when the fiscal year ends? So some of that may need to be recorded differently, and it may end up being in a different period. And so just making sure we understand that. So it can get a little bit complicated depending on how your due structure is. So making sure you have that. And then again, we can only recognize that revenue when we have satisfied that performance obligation. One of the biggest changes for associations and membership organizations is that concept of when you bill, you may not actually have a receivable. So if you are, let's just say you're a 1231 organization and you send out all of your membership invoices for the next calendar year, you send them all out in December, and you come to your December 31st financial statements, the new standard will tell you you don't have a receivable. Because you have not entered into a contract. That person does not have a requirement to pay until the next fiscal year. Until they have a requirement to pay, you don't have a receivable. So in the past, some organizations would actually gross up the balance sheet. They would have, you wouldn't let your clients do that. It happened a lot in higher ed. They're freaking out. But so if you did do that, you can't do that anymore, and it's just a balance sheet reclass at the end of the day. A lot of people, well, my accounting system triggered an entry. Well, okay, we can then do a high-level entry to back it out at the financial statements. Right. So the question was, we invoice in December, and some people may be just Johnny on the spot, right? We've got those members that pay right away. How do you account for that? The same way you always did. You debit cash, you credit deferred. The revenue you can't recognize until next year. You don't have a receivable, though, for those that haven't paid as of 12/31, because they aren't required to pay until January 1st. So the question is, what if the members get a magazine as part of membership? Like, I get a Journal of Accountancy every month that comes and sits on my desk until I move it, right? Yes. There could be tax implications for that. Karen, where's Karen? But that's where you need to step back. And I actually would use that as a joke whenever I would speak at AICPA conferences. How much of our dues do we believe should go to that journal? And it's looking at it, what is the fair value of that magazine if somebody were to go out and purchase it on the newsstand? And maybe it's just messaging, and it's just part of our overall, communication, which is stand ready, and therefore we have it just available. Is most of that content also available on our website? Those are questions you have to ask yourself. I don't think the AICPA, because they did talk about how they allocated, I don't know that they allocated any to the Journal of Accountancy.
Okay, now the biggest question I would have is, we bill in, October, November for the end of the year. It's all sitting on deferred. Where my question is that the dues year is from January 1 to December 31. However, we don't drop members until March 31. So they are effectively, if they don't pay, effectively getting 2 more months. Do I have to take that into consideration? Because it wouldn't be everybody, it would only be a handful.
I would say you would want to assess that and tell your auditors it's not material. So if you bill in October, so the issue becomes, the reason why you couldn't have a receivable until January is because that individual isn't contractually obligated until they keep having, it's the legal. But yes, for your standpoint, you're saying I don't actually cut people off. I don't rescind their login or any of that right, because hopefully maybe they'll be like, oh, wait a minute, I just forgot to pay, right? And we can still do that. That's up for you to decide. Again, how many typically turn over? Can I look past that piece of it? It's the same thing as a sales return. If you think about it I don't know if anybody in here, I used to, one of my big clients used to all be retail. Most major retailers, have, most major retailers have a January 31st year end, because most Christmas returns will come back in January, or they'll never come back. Most gift cards are spent within the first 30 days, or they're never spent. And so that's one of the reasons. So again, it's that same concept. You can look at what that breakage would be and have that estimate. But have it documented, because somebody's going to ask, right? How did you go there? So I talked about now, is a portion of your membership dues, is a portion of your revenue stream, both contribution and exchange, reciprocal and non-reciprocal. And think of the arts associations, or maybe the animal associations, the zoos. They may have some of those membership levels where you can pay $125 and you can get a zoo membership where you get unlimited access to the zoo, right? That's stand ready. That would be amortized over the life. That's exchange. Even if you never show up at the zoo, I was here for you. The animals and I were here waiting for you. But for $500, you can now be a silver member, and you can have, or not, probably a panda member, if we're talking about a zoo, right? They always give them the cute names. And we'll put your name on the panda wall, and then you can actually come and, feed the pandas. And by feed the pandas, watch one of us feed the pandas, because we're not going to let you anywhere near the panda, right? So how much is that difference worth? So we now went from 125 to 500. Is there a contribution element in that? And as an organization, if you do that, you already know that you're sending that individual person a tax letter saying X amount of your contribution is tax deductible, right? Same if you have a gala. So if you have that, this is what this flow chart, we like flow charts. If a portion of that contract, so whether it's the zoo membership or you're having a gala and it's $1,000 a plate, and we all know that the food is only worth $20, right? That you kind of walk through and say, a portion of that is another guidance, which in that case would be contribution guidance, which means you would recognize any contribution portion based on that guidance. Is there a donor restriction relating to it or not a donor restriction? So which column of the revenue, but you would recognize the revenue right away in one of those two columns. The rest you would walk through and apply this standard. Does that make sense to everybody? AICPA, and I was actually part of this, spent quite a few years of my life on this one. There is a guide out there. The AICPA issued a revenue recognition guide. It's got some general chapters and it has specific chapters one on healthcare and one on nonprofits. And there are examples, and you guys made it, subscription and membership dues. There are examples in there of how to account for it, what the journal entries should be. You're only one of 2 problem kids that we said had revenue concerns of how things may change. If you don't want to buy the guide, talk to your friendly auditors. They'll have it available on an online subscription and can get you the chapter that applies to you. But it will walk you through, help give you example disclosures, help you understand, kind of where we need to fall on some of these. There are a lot of other chapters as well. So if you have other services that you're selling to your members and you want to know, well, how would I account for this? There's chapters relating to every type of revenue stream that are out there right now. I said the disclosures are going to change, and they are. We now have to disaggregate revenue. And it's where in the past you probably were doing this anyway in the face of your statement of activities, but it's just making sure that if you weren't in the past, you are delineating it a little bit more now in the footnote. So a qualitative disaggregation of revenue. What are the different revenue streams I have? I have membership dues. I have, what else? I've got sales to my members of direct product, whatever those different things may be. Again, only the material items, that's all you need to worry about. And if you have immaterial items, you don't need to put those in your disclosures. You just need to document them for your auditors so that they'll leave you alone. The rest of the disclosures all relate only to public business entities, which don't fit into this category here. They have a lot more. The effective date is now. 12/31 will be is the final effective date. June 30th coming for the fiscals, but this is the deferral for the non-public business entities. We'll be applying it as of 12. You ready, Melissa, to apply it? We're ready. So if you're still getting ready, and I know Andrew, you're still getting ready, right? You were talking about at our table. Again, inventory your revenue streams. What's out there? If you haven't done this already, you have to. If you're expecting your auditors to help you, they're not going to have time. The closer you get to your year end, the less availability they're going to have because everybody is putting it off until the last. So if you are June 30th, reach out now and ask for help. Which Andrew, you are, and you said you were having those conversations. If you're 12/31, pick up the phone as soon as you get back to your office and say, you know what, let's have a conversation about this. Because if you wait until they're out there doing the audit, it's too late. There's too much to go through, and they're not going to have capacity, just given the sheer volume and based even knowing in our practice, the number of people who have actually raised their hands and asked for help isn't near where it needs to be at this point. So just making sure you know that. And always look through the standard for the practical expedient. If it's complete within that fiscal year, focus on the disclosures. What disclosures do I have to have? There's some large nonprofits that adopted early. You can go out and look at some of those financial statements. I know AARP was one of them. I think the American Cancer Society was another. Materiality, again, if non-contribution revenue isn't material, which it is for you guys, your dues obviously are material, but if the other items outside of your member dues is not material, just looking at how much of it actually falls outside of my fiscal year. Do I need to worry about it, or can I just document it's not material and let's move on? Don't go too far down any rabbit holes.